Good afternoon, everybody. Uneducated Economist here. So let's talk about what happens to bond yields in a low interest rate world when the rates begin to change. Because that's what I feel is going to be happening here over the next probably couple of years here in the United States. A lot of people probably will argue with that, thinking that the interest rates would never go up, that the Federal Reserve would never stop printing, that they would never back off on their tapering or quantitative easing, that it was going to be pedaled down from here on out. That is a very common theme that was being stated out there. I mean, even in the recent videos that we have done here talking about Mohammed El Aaron, the famous economist, saying that, the Federal Reserve has missed the mark. They made the worst call in history by calling inflation transitory, and that they need to step up their game in order to regain the narrative on the inflation, or else they'll lose this narrative to the inflation expectation and it'll just run out of control. But even then, he says that, but don't take your foot off the gas. I mean, just ease up off the gas a little bit. You still want to keep printing money and going forward, right? I mean, that's what he says, even though he was saying what was going on there was like bad. Anyway, so I just love that when somebody was just like, oh man, they totally missed the mark. They're missing inflation. Inflation's going to run hot. It's going to run so bad. It's going to kill everybody. But they better not stop yet because they just need to ease up a little bit. Don't quit printing. Anyway, so what this has done to the investors, though, think about this. Like, if you have a low yield on a safe asset like the U.S. Treasury and you're looking for some sort of yield, what do? You have to take on ever-increasing amounts of risk. And that's where a lot of people were finding, like, the junk bond market to be, like, the place to go to because you could get a return off of it. Not to mention, so many investors were pouring into the junk bond market that every time you started getting into the junk bond market, the yields kept falling and the prices kept going up. So it turned into be a great speculation as everybody was getting into this, high yielding corporate debt. And now what ended up happening with the high yielding corporate debt, along with things like the municipal bonds and pretty much any other like fixed income debt out there that has a fluctuation to it or a price tag to it, is the yields on everything started to come down. Everybody's pouring into it. Right? They're looking for that higher yield. The more people who get into it, the more the yields come down and the prices go up. So that's what's taking place here. Now, think about this. If the yields on these junk bonds, right? This high yielding corporate debt, if the interest that they pay starts to come down because so many investors are pouring into that asset and it eventually finds its way closer and closer to the U.S. Treasuries, the moment that the U.S. Treasuries begin to rise in yield, the investors are going to look at the risky assets going, why are we sitting in this high-yielding corporate debt or whatever risky asset that we're in when we could be buying the safe haven asset of the U.S. Treasury? They're going to start getting out of that and getting into the safe havens. Okay? What happens to the junk bond market? Right? The yields begin to rise. Well, pretty soon the corporations can't make their payments anymore. You have a situation like we have over in China with Evergrande. Now, Evergrande is sitting in a situation very much like that. As the Chinese government began to raise their interest rates, trying to reel in some of the irrational exuberance, these corporations could no longer afford to roll their old debt over into new debt because the interest payments were too high. If you can't make your payment, you start to default. If you start to default, then you have to start paying your debt holders. How? By selling off your assets. And that's what Evergrande was doing. They were selling off assets. But it wasn't just Evergrande that was having the problem. It was all these property developers that were having issues over there. I mean, it's not just one corporation. These guys have contracts with all kinds of other contractors out there. And if they can't pay those contractors, then those guys begin to go into default as well. And so you have this contagion thing. This contagion that starts to take place. But it's not just in like, hey man, you didn't pay me for the contract I did. A lot of times these corporations, the way they get paid or pay is with something called commercial paper. So the easiest way to explain commercial paper is if a corporation owed you, say, like $98, right? They can pay you with this commercial paper. This commercial paper is a contract that when it is due in a year from now, it would pay $100. So you can make a little bit of interest just simply by holding on to this commercial paper for a year. right? Or so. And if you needed the money, you can just, sell it at any given time and get, whatever it is that was owed to you off of that paper. So this is a good way for, like, corporations to pay out, because they don't really, actually, it's kind of like a borrowing. They don't have to pay. They can take out a little bit of a loan when they do this and just kind of postpone the payment for a year. It's a great way for them to do that. It's a great way for somebody to earn a little bit of interest off of a payment that they have received. They put this payment, this commercial paper, on their balance sheet, so now that's part of their assets. They have liabilities. When that asset, that commercial paper, begins to lose value because Evergrande's going into default and is not going to pay 100 cents on the dollar of that thing, they're only going to pay, like, you're only going to get 50 cents on the dollar. Well, pretty soon, here you have this asset on your balance sheet that's losing value, and it's offset by your liabilities, and now your credit rating is starting to go down as well. And now you can't make your payments, and rolling your debt over into new debt becomes ever increasingly more difficult. And if you can't pay your bondholders, then you start selling off your assets as well. Now, that's a situation that has taken place in China, and I feel that contagion can just keep spreading as long as, like, they're unable to regain that ability to start rolling that debt over into new debt. Now, China is trying to do something about that. They are trying to go into more of an easing kind of policy to prevent this from deteriorating even further. But they said a few months back that they were going to allow property prices to come down. Remember, we did a video on it. They said they were going to allow the property prices to come down to try and encourage families. This is something that I thought was quite interesting. It was just like, well, wait a minute here. I thought, like, loaning out money was supporting, like, when you drop interest rates and you loan this money out to the people. I mean, you listen to the Federal Reserve, they say that that's supporting households and businesses when they do that. But over in China, they're saying, no, we need to reel in some of this irrational exuberance, lift some of these interest rates, drop some of these property prices down to encourage people to start families. Well, why? Oh, right. Because the irrational exuberance of having low interest rates causing these loans to go into properties, driving the property prices up, makes it ever more burdensome on young families to get started. I see. So you see what's happened here is that China kind of figured, they already knew this a long time ago. They just told the people, it was just like, hey, we're going to go ahead and bring this stuff down. What we're going to do is raise the interest rates, and all these property developers are going to end up losing out. They didn't say it like that, but they ultimately said that. So we need to bring the property prices down to get families started. And that's what's happening right now. So over here in the United States, we can see something very similar starting to take place. And now look at the article that I have down in the description for you guys, talking about the municipal bonds and how they're starting to go into defaults and what do they call it, impairments, like the inability to make the payments on these municipal bonds. Now you've got to think about it. Like, municipal bonds is like kind of been like the safe place to go to outside of the U.S. Treasuries. I mean, it's like governments, like, local and state governments that issue out these bonds. So you would think, like, out of all bonds being issued by by people, especially the higher yielding ones, that you would think municipal bonds would be like the safer place to go to, but it turns out that they're not that safe. Go and check out that article that I left down there. So now this is something that I thought about. It was just like, man, the interest rates haven't even begun to rise yet. They haven't done anything yet. Just the mere thought of it has already started to shift the markets and the investors' perception on what it is that they want for a yield. See, when you were getting into these high-yielding debts and you saw the interest rates coming down, it was more of a speculation. Like, you saw it was just like, yeah, they're not that great of yields, but they're higher yields than, say, the U.S. Treasuries, so I do get something out of it. But really, all these people are pouring into the high-yielding corporate debt that I'm pretty sure that these prices are going to continue to go up. And that's really what it was down. Is like, for the last couple of years, these investors have been speculating in this high-yielding corporate debt, or just high-yielding debt in general. But as soon as the markets change, or as soon as the interest rates change, the market's perception changes as well, and they're like, oh man, this is kind of risky stuff, and I don't know if I really want to be involved in it any longer. Next thing you know, the prices of those bonds start to go down, the yields start to go up, and then the rolling over of old debt into new debt is just no longer available, becomes more cumbersome, taxes have to go up, governments have to be cut, stuff like that has to start taking place in order to deal with it. So that's what I feel is taking place right now, is that the market perception of higher interest rates are going to start causing the yields on high yielding corporate debt, municipal debt, all these things that are kind of risky, it's going to start causing the interest rates on them to rise just off of the mere perception of higher interest rates coming into the future. They don't want to tie their money up with risky assets. This is what it comes down to. All right. Let's see. Was there anything else I wanted to talk about? Oh, and for those, here we go. Because I'm sure the argument is that no worries, the Federal Reserve will just print up a bunch of money and buy all these corporate debts, right? That's going to be the argument behind it. The Federal Reserve can't necessarily do that, right? Now, people might shake their head saying they just did it just a few months back, right, with the special purpose vehicle, but they had that set up with the Treasury using an unusual and exigent circumstance, meaning that right now to set up a special purpose vehicle would take a crisis or some sort of like emergency, an unusual and exigent circumstance. I'm not saying they wouldn't find one, but as far as right now, I don't believe they have one, and therefore they wouldn't just be able to just fire up the special purpose vehicle and start loaning money to or buying up corporate debt. However, they might be able to buy the municipal debt. I mean, I don't know if that's something that, like, is accessible to them. So anyway, that could be a possibility. Uneducated Economist, you guys let me know.